Good afternoon. This is Tim Legman with BIS Commodities, taking a look at the review this the second week of July. Let's start out and see where we close for the week on some of our commodities. We look at September corn down 11 cents this week at 341 and change, the settlement price. August beans down 59 cents on the week at just a hair under 8.19 in the August contract. September wheat down just under 19 cents at 4.97. August cattle down $1.82 this week at 104.55. July hogs down $1.42. That contract is set to expire on Monday. It closed at 79.95. August hogs are down $5.27. It'll be the lead contract month starting Monday, and that closed at 70.15. So we've seen some pretty big pressure there. The dollar at this point still trading up 75 points or so on the week, and it looks to be possibly an outside week up if we settle up here. Crude down almost $3 on the week currently, as it is still trading at 70.85. The Dow looks to close almost well over 500 points higher, 544 or so, right around that $2,500 mark. The main thing this week in the corn and soybean markets were the USDA report. It's the monthly supply and demand report, and we're going to take a look at a couple of things. One, we're going to take a look at the incorporated acres from last week's acreage and stocks report and plug those into the equation. So we did see more acres, so we were expecting a bearish report going in. And the surprise, if we want to take a look at corn here, is that we didn't see an increase in the ending stocks as we thought. We left that old crop stock number pretty much the same. It was a little bit lower, down 7 million bushels or so on us. Primarily there were some adjustments made, but exports continues to be very strong. But the big push down, it was the new crop. And I shouldn't say it was a push down, and actually just wasn't up as much as we thought in the ending stocks. We came out there at 1.55 billion bushels, and that is was actually down from the previous month. And the primary reason there is we've seen a big push upward in exports, which have been very strong at these price levels. We have yet to adjust a yield. Historically, we rarely see the yield adjust in the July report, whereas the August report is where we may see some adjustments to take place. Taking a look at the soybeans, a little bit of a bearish or a bullish surprise, you could say, in the ending stocks for old crop. We did see a reduction of 40 million bushels from last month at 465, still a very comfortable number out there. We've seen the increase in crush and exports to lower that number. But the big question going into this report was what were we going to do with concerns about the Chinese tariffs? And USDA answered that question as they lowered exports in the 2018-19 ending stocks. They lowered the exports 250 million bushels. So that gave a bump to the ending stocks number up to 580 million. And that came in, that's up from 385 last month. And it's well above the average estimate as well, almost 100 million bushels above the average estimate. So as we move forward, we had the acres in place. We didn't see an adjustment in yield. We got a number out there now. As far as we're concerned about is how much are we going to get whacked on exports due to the Chinese tariffs, yet to be determined. That gives us a baseline number moving forward. Now, as we move forward, we're still seeing pressure. We're seeing lower lows. Technically, the charts do not look good in soybeans. We're still continuing to push this thing lower. Uncertainty is still out there. One, momentum is to the downside at this point. Two, the uncertainty, and three, weather. Right now, weather isn't considered threatening for either corn or beans. We came into the week with cool down in the forecast. Now we got to see if it follows through and see if the rains come through and hit some of the drier areas, but that'll be the driver, I believe, over the weekend. The tariff talk is still out there as well. and anything can happen over the weekend there as well. The commitment of trades report released today showed that we added about 35,500 contracts to the shorts in the managed funds. They're short about 105,000 contracts of corn now. Soybeans were pretty much unchanged for the week, but we've seen a lot of volatility. We had the big up move last Friday, up 38 cents or so on the settlement. We did see the settlement come down, and that was, or the bean sell-off since then, and that was the announcement of another $200 billion of products coming out of China, another 10% tariff possibility there that weighed upon not just our markets, all markets this week as well. Taking a look at the livestock markets, no cash trade yet as of this afternoon. We did see the choice cutout grind lower this week, about $5 lower on the choice, trading around 204.70. Analysts are projecting that $200 level now, possibly another $5 or so. We're getting in a time period where we see our least demand as far as beef is concerned. So the futures followed up last week's breakout, 3-month breakout, with a choppy lower trade this week as well. I would expect we're going to continue to see a choppy trade in the next week. We'll see how cash trades. That'll probably be the driver here. We are seeing the funds adding to their length. They added about 2,600 contracts, so they've been adding for the last 3 or 4 weeks to their the length on their side. So that would be supportive on some of these intraday choppy trades that it feels as if they're going to be in here and support their positions. But again, I think the driver next week will be how cash performs yet today and or tomorrow. Cash for hogs have been pretty ugly. We've seen it getting whacked all week here. We've seen the follow-through. We've seen the hog and pig report a week ago Monday that weighed upon futures this week. The deferreds were hit especially hard. The main concern there is tariff as well. If we're going to see something come through, and not only with China, but we still have the NAFTA Trade Act that's still out in limbo yet at this point. May exports actually were up 5% from the previous year, so that was somewhat supportive. But still the uncertainty of everything is weighing on this thing. Interesting enough, we did see December futures trade at a $35 discount to the cash index, and that is on record as the widest margin we've seen. So we've taken a lot out of those deferred contracts, primarily to the hog and pig report. Showed plenty of numbers coming in that third and fourth quarter time frame. So the question, I think, for hogs next week as well is going to be take a look at the cash market. If we can stem it there and hold serve in the cutout, maybe we can find some support. I do feel, though, even now at these price levels, rallies are meant to be sold. So if any questions about these or any other markets, please feel free to give us a call here at BIS Commodities at 1-800-373-2525.